in regards to rotation and higher rates. Okay. That's obviously, as you guys know, if you've been attending these webinars, that's been going on for several weeks now. Okay. And in simple terms, the playbook is when rates push higher, right? Algos, hedge funds, what they do is they sell high multiple, high PE growth names. Initially, some of the tech stuff fall into that category, but not mega cap tech. All right, we'll talk a little bit about that. But a lot of the growth names, all the names all of us love to play, right? All the exciting times we've had on these webinars and talk shop in regards to sweeps in high growth, Cathy Wood type plays. Those are the names that algos and hedge funds instantly hit the sell button when rates become a problem. Okay, I don't know the exact number. There isn't an exact number. It's just when rates are a focal point, right? When you hear a lot of noise about rising rates, that's the playbook. So what we've seen for, like I said, probably the way time goes by now, I say weeks, it's probably longer than that, but several weeks, okay? We've seen a lot of those high growth names get pulverized, SPACs destroyed, EV plays destroyed, right? You guys are well aware of it. I'm sure you follow a lot of those names, okay? And all that money, even FANG, okay, and mega cap tech, they didn't necessarily get hit as hard, but they were being sold to raise cash and to rotate into the stuff that the playbook calls for on the buy side. That's commodities, reopening names, cyclical names, travel and leisure names, all that stuff, okay? So we've seen this quote unquote playbook play out for several weeks to the point where it got out of control, right? And that's something we spoke about recently. Financials, you pull up a chart of Goldman Sachs, yeah, you don't need to know how to read charts or sentiment or anything for that matter. You know, you pull up some of these charts and you say to yourself, my God, do these things run hard, right? Energy, some of the energy names. Again, commodities, travel names, right? So you had this mad rush, and you got to understand, right, how the psychology of, forget investors, gamblers work, right? What they do is once they get wind, they don't want to believe the playbook initially because they love these growth names. They don't want to sell these growth names, okay? But once they become believers, right? Once they get frustrated enough with growth that they have to buy something, they come and bum rush these names no matter where they're at, no matter how much they're up over the last few weeks. And that's where you get stuff like this, okay? Right? Just crazy moves, right? Insane. This one today was down. If you scroll back far enough, you can't even tell it was down. But, you know, deer, nuts. Freeport, which was one of the first to actually start cooling off, has been finding some trouble. Again, we've gone over these names ad nauseum, okay? So once the playbook becomes public news, once everybody's aware of it, you got Bova putting out notes of what stocks to buy, what stocks to sell. Morgan Stanley, JP Morgan constantly talking about this playbook, okay? It gets overdone, and now what happens is you have, because of that rush into these things, you got crowding and full positioning in this whole chunk of the market now. All right? So it all stems from rates. And that's what we've been talking about. We don't know how long this can go on for, right? If rates continue higher in a straight line, they probably could get even crazier, right? To the upside. But we don't know. So something interesting happened coming into this week, all right? And what happened was you had bonds that had been selling off, hence why rates are going up, right? Bonds go down, rates go up. Bonds have been selling off continuously. And now you run into the end of the quarter, okay? And the end of the quarter is significant now because what you have is you have these huge pension funds, right? And because of the decline in bonds and the run up in equities, these balanced funds have to rebalance their portfolios. Okay, so let's just take even numbers, for example. If you got a 50-50 balanced fund, 50% bonds, 50% equities, and bonds do this and equities do this, right? That percentage is off whack, right? Because of the increase in equities and decrease in bonds. So now what these pension funds have to do at the end of the quarter, you hear the term rebalancing, right? They got to rebalance. And in order to rebalance, they have to sell equities and they have to buy bonds, whether they like it or not. Okay? Bonds couldn't find a buyer for the life of it for weeks, months now. Okay? Now there's a forced buyer. Okay? So what's interesting is now you have kind of a floor put in to bonds, right? In the bond end of things for now. So that keeps rates from continuing to rise, correct? All right. What that translates in now, we figured that part out, right? I want to make sure everyone's tagging along here. Okay. We have a forced buyer in bonds that's going to cap off rates over the short term. Okay. So what's that mean for the playbook? Everybody's been rushing into higher rate plays and selling the stuff they need to sell because rates are going higher. All right. So now what they have to do, or what they do, now you don't have to, but what they end up doing, they start to take profit, right? And sell some of these things that have been running higher, basically in a straight line of higher rates. Okay. Because again, rates aren't rising now, right? Bonds are rallying, so that puts a cap on rates rising. So they sell all these reopening, inflationary, travel, leisure, all the stuff that they've been rushing into. All right. And positioning has been so full in these particular groups because of the piling on week in, week out of going into these names that, the selling feels worse than it is. Okay. And that's kind of what we got today. And the truth of the matter is we're going into the end of the quarter here. So the likelihood is may get worse. Okay. Now, what may end up happening here is that players, right, the smarter money who bought these things early on in the trade and likely have taken some profits or protected some of their profits, they may decide at a point in time to come in and buy this dip because they feel rates are going to end up going higher when this is all said and done. The economy's reopening, et cetera, all the reasons. And they may decide at some point, some level, to come in and buy these names again off a pullback. Okay? So that's in simple English what's been going on in the price action. Okay? That's it. And, if you guys remember, we talk about this a lot, right? You see names go higher and they keep going higher, right? And what we use in the steam room, right? We use sentiment to give us an idea of when to put the guns back in the holster, right? You need something to put you in check so you're not chasing this for swing trades, 3-6 months out. All right, because we've gone over this, several times. If you're buying here for a swing trade, you may be up over the next couple of days, right? The next week or so. But if positioning is full and it starts to sell off, you're going to get caught in something like this. And a lot of people in the steam room play options. And when you're playing options, something like this can destroy you, if your entry is pretty bad. Okay, so that's what we use sentiment for, and that's what we've been looking at of recent and trying to stay disciplined. Now, like we were saying, we can still play off the momentum within this tactically, right? Where we're get out type of thing, especially day trading. But for swing positions, it's a really difficult, it's an ugly risk reward. Okay, no matter what the end up is. All right, so just to show you guys where we're at. Now, this is coming into today. So it's going to look a lot better when things update today. All right, but here is in some of the stuff we look at, basically just showing you everything I just mentioned, right? So this is kind of the stock to bond ratio. And every time this thing dips above the red line, usually there's some sort of dip, okay? Some sort of dip in the market, okay? When you run into the end of the quarter where pension funds play a bigger role, that dip may be more significant. Not always, but could be. Okay, so this is the stock to bond ratio, basically showing us what I just explained to you guys. Okay, here is, and we looked at this for a few weeks now, right? Sector sentiment. And look at all the reopening, or I should say the higher rate, right? Higher interest rate, according to the playbook, sectors. Basic materials, right? Poor risk reward. Financials got up there actually for a week plus, maybe even 2 weeks. Poor risk reward. Okay. Energy overshot to the upside. Poor risk reward. Industrials, poor risk reward. Right? Here's oil again. Poor risk reward. Mining, poor risk reward. Okay, and again, this didn't just happen this week, right? We spoke about this last week. Okay, what was interesting though, a couple of weeks ago, was that because the rotation was so excessive, it left things like technology, the semis, at solid risk rewards for a trade. Okay, but they've rallied since. All right, so this is where sentiment, this is what sentiment was showing us, right? We'll see, how much of a dent today makes. But ultimately, like if we're looking at these sectors, and we'll talk about this a little bit more, right? We would love to see these, all the stuff that we were interested in but couldn't buy because they just got too crazy, get at least close to flashing buy signals, right? Like energy, you're not too far away already. And some of these energy stocks have been holding up well today, considering, what crude was doing. All right. Some of the others have more to go, but it happens quick, just like it did to the upside. It can happen quick. All right. So that's what the playbook in sector sentiment was showing us. If you look at positioning, right, aside from sentiment, a lot of it was showing the same things. Okay, look, asset managers too bullish in the Russell, which they were buying, and they got too bearish in Nasdaq. All right, and that's kind of what we've been seeing the last couple of days. The Russell's been getting tattooed, and the Nasdaq, was red at the end of the day today, but over the past week, has held its own. All right, so we see it there on the positioning side too. This is the same thing. This is Nasdaq positioning. So you can see a total different animal. All right. Now, I wanted to say this earlier, but here's what I think, and it's not something I really want to hang my hat on per se, because I don't want to assume that it's going to continue. But what my main takeaway from the last few days, okay, is while they've come in to buy the Microsofts and the big tech, mega cap tech Nasdaq names, okay, with rates sort of taking a breather, they still haven't had much of any interest in these growth and high multiple names. As a matter of fact, almost anything of speculative nature, right? We've been talking about that risk appetite for spec. Right? Give me SPACs, give me GameStops, give me a pump and dump. The more speculative, the better. Give me a $2 name. Hell, give me a 70-cent stock. Those things are on fire right now. Okay? That appetite was unquenchable. And now a lot of this stuff, right, we're seeing blow up one by one. All right, we're seeing them blow up one by one. And there could be a lot of reasons for that. We'll get to that. But that's what I found really interesting. Like if they should have come in to these growth names for bounce at the least. They should have come into these beaten up high multiple names for not even more than a bounce, an intermediate term uptrend type of thing. That's how blasted these things have gone, right? They've been eaten up, and they haven't. A lot of these things haven't. They didn't even find the floor, let alone bounce. And I find that really interesting. Now that can change tomorrow, but I find that's what my main takeaway from over the last couple of days. So since this has all been going on, here are hedge funds, okay, and all they own right now are reopening and higher rate plays. Okay, they're not all in to flash a sell signal, but they're up there, right? They're up there. Here's a hedge fund reading from Bova. All right, so they've been net buyers every week since Feb 2020. What? Wait a second. Feb. Oh yeah. What year are we in? The fuck? Feb 2020? That might be a typo. I think that's a typo. That's a typo. Right? Unless he means they've been covering short. Yeah, that was before the thing. It's a typo. All right, I forgot what year I was in, Dan, for a second. Jesus Christ. So they've been buyers of recent, okay, this year. Institutional clients, they're doing the opposite, right? They've been selling of recent, March, so this month. All right, private clients are Bova's clients, and they've been buying hand over fist. Oh, you know what it is? They got it backwards. I think this should be 2020, and this should be 2021. They just screwed that up. So here's some other interesting things here. All right, this is out of Goldman, so it doesn't measure every hedge fund out there, but this is kind of where they stand as far as positioning relative to the last 10 years. So that's how they like to measure things, Goldman. I don't really necessarily like to look at things that way, but Goldman loves it that way. All right. And you can see, look at this. Okay. They were here and now they're here. I think that's the way to look at it. Yeah, materials, right? So they've been just rushing into a lot of these reopening names through Goldman. All right, doesn't measure every hedge fund, but the ones that do business through them. And here's another look here. So you got retail, leisure, energy. Look at the airlines. You know, a lot of the other stuff. Okay, I'm just making the point that it got really crowded over a short amount of time. All right, and when something cracks, you know, you get, and it's nothing major. It just, you know, a lot I see, especially on social media, a lot of people scratching their heads. Oh man, what the hell is going on with Micron? What? It's down today. Yeah, it's down today. But, you know, that's what it feels like when when you got players rushing into it for a good 2 months, and now you got a crowded position and people need to sell, you know? But in reality, it's not a big deal and it's healthy. And this is something, you know, we've been talking about now for a few weeks, that, you know, we want to see this before we could become interested in these things. I don't know about you guys, all right? But for me, you know, and this is more of a thought before coming into, but it's getting more difficult for me to pull the trigger on a swing position. It's not getting easier. It's been getting more difficult. You know, now even some of the sweeps I like, you know, like I like the order. It's a good looking order. I can't get myself to even start buying because I feel like things need to come in more. You know what I mean? Things need to come in. Like, this is not, what you're seeing here is not the type of environment you want to go be a cowboy and buy calls in. You know, it never made sense to me, like, when people in one breath are complaining about the money they're losing, and before their lips can even close, they're talking about what calls they just bought. You know what I mean? Like in the same breath. Oh man, I'm getting destroyed on these calls I just bought 2 days ago. I'm buying Boeing. You know, it's like the market. That's the one good thing about the market. You guys have heard me tell you that time and time again. It will teach you. It will tell you emphatically certain things. Now it's up to you whether you listen or not. But, you know, if you don't listen, I mean, you deserve to lose money. Let's be honest, right? When you go and you buy something, or, you know, you're buying off sweeper activity that was solid for a day trade, but doesn't do what it should do on a swing trade basis, the environment's telling you something. You know, the environment's telling you something. You don't think I'm licking my chops, staring at this flow day in, day out? I'm staring at the flow all day long. You don't think I'm licking my chops to buy calls, to swing some calls? You know? But the reason why the reason why I can't is because I see what's happening in front of me. There's nothing, especially now with some of the groups that were overstretched to the upside, overcooked to the upside. Now they rolled over. There's nothing that's giving me the itch to hold something for a swing trade. You know, and knock on wood, outside of today I played one name, ATVI, earlier on today and didn't go anywhere. But outside of today, thank the good Lord that there's been momentum off some of the better action out there for intraday moves. You know what I mean? There's been legitimate momentum where you can catch some decent moves intraday off the good-looking action. Thank God for that. Because a lot of times you come into, certain environments that are rough, and, you better get the scalpel out because day trading's a bitch, But there's been some nice rips out there intraday. A perfect example, you know what? Here's the perfect example. Here's the epitome of everything I'm saying, okay? QS, okay? QS got annihilated yesterday. It ripped $6. Not 1, not 2, not 3, not 4, not 5. $6. Ripper. You think that was enough for most people? You know what I mean? $6. And it probably wasn't enough for a lot of people. All right? No exaggeration. But that's my point. That's my point. And the thing is, QS, okay, they hit so many different lines from the morning all the way to the close, okay, that I don't even know what month you would have picked. Probably they end up deciding to pick weeklies, I'm sure. But who knows? QS might be a winner by the time some of those calls expire. I have no idea. But the point is, you cannot be surprised by the price action over the interim. Remember we spoke about Netflix, right? It caught some really good looking action, Netflix. Really good looking action, swingable action, okay? But make sure, right, if you're going to buy Netflix with a little bit of time, make sure you're prepared and anticipate a bumpy ride, best case scenario. Best case scenario. All right? You cannot be surprised if Netflix, which went up right after the action and looked good, is down 2 days later. You understand what I'm getting at? So if you have no interest in intraday trades, then, and you have to take that extra risk to swing trade, just understand that what you're dealing with here. You're not dealing with what we had, the environment we had fall and winter last year. We're not even close. Not even close. So you have to be prepared for that. I'm looking, as I'm talking here, I'm looking for that the one chart. I could probably find it on my Twitter. It'd be a lot easier. Hold on. So, we were talking about how this sort of, by the way, no riffraff they're long. Okay. So on top of everything I just mentioned, we got the riffraff freaking long again. That's not the riffraff. Where's the riffraff? Here we go again. Oh, here. Yeah, we got the riffraff long again. All right. So that's not going to make things any easier. But I want to show you guys this thing. And, I talk to myself and say I may be getting a little carried away, but hold on. But look at this. Let's see if this will pull it up. Yeah. Okay. All right. So this is the financial conditions index. And, why things were so easy, it felt like there was money all over the place throughout this whole rally because of what the Fed, the Treasury, and everybody has done, right? And, this is a chart of the financials index according to Goldman. When it's going up, it's tightening, and when it's going down, it's loosey-goosey, right? And what you have here, because of the Fed playing hardball, you have tightening of financial conditions without even the Fed doing anything. and some people may think I'm nuts. I think this plays a big part in the type of market we're seeing in front of us now, where things are just more difficult. This here, right? If you guys remember, and it was mostly this, was the end of 2018 when the Fed was playing hardball, right? And wouldn't listen to the markets. And you remember how orderly some of the selling was then? It was the same type of thing. You look at the indices and they're flat. One of the indexes are up a little bit, but underneath the hood, breadth was awful. Individual names, awful. So it's early yet, but starting to look like that to me a little bit. Maybe not on the same scale, but it's starting to look like that. Okay, you look at the indices and everything looks fine. Underneath the hood, individual names are getting wrecked, especially the ones that are seeing the selling. All right, and that takes me to one final point I wanted to make to you guys, that we've been talking a lot, especially I would say the second half of the rally, on how the best, for the most alpha, we should look to individual names and forget about the indices. Remember, we talked about that a lot. Forget about what SPY is doing. Okay, pay attention to the sweeper activity, what names they're hitting, what groups they're hitting, and that's where you're going to make the money. And I think we're starting to get into a climate where it's the opposite of that. Where you get, for trades, you ignore the action in individual names and you try to find entries in SPY. All right, and I think this is one of the reasons why. Okay. It likely all comes to an end once the Fed pivots, or maybe the market's wrong, right? Maybe the market's wrong, rates, end up settling in, there's no crazy move, and we live happily ever after. But the Fed is the one usually wrong. And I mean, just logically, and the Fed admits it, logically, rates are more than likely going to push higher with the economy being switched back on. That would be totally normal. And there's nothing wrong with that. Okay, but it's not going to be an easy time or a good time to make money in individual names if that's the case. You understand? That's the difference. Like people say, oh, what do you want the Fed to do? Keep interest rates at zero? No, I don't. Listen, I'm not saying it's a bad thing that rates rise. I'm just saying you're not going to have the same type of market you had where, you had sweepers bombing the living daylights out of every single thing under the sun, and you could swing anything and everything. MAGA time, right? You're not going to have that. That's why Trump wanted it, right? That's why Trump, Andy, was begging for it. Because he knew. So that's, again, we'll see how it all plays out. But, we got to acknowledge it. We got to be aware of it. We got to be aware of it. And that's why, I've been so reluctant to, I could go force myself and put on a swing position, and win or lose. It's not going to make or break me, but it's just foolish for me to, I spent my whole career trying to be disciplined and do the opposite of that, to just go out and just swing for the sake of swinging. I'll focus my energy and time on trying to day trade while that's still the best risk reward out there. And then eventually, the inevitable is there's going to be a decent time to swing trade again. It's just not now. In the meantime, you could create watch list, the hit list, like we've been doing already. There's been some decent action with time out there. All right. And just, staying on our toes and being ready, because a snap of a finger, something can change all that. Right. Maybe the Fed says the right thing one day. Right. Maybe rates start to creep higher, and now there's an issue in the credit markets. And guess what? The Fed's got to take some action. Just like that, things change. So that's why, you don't want to build too much of a bias, and you don't want to be too fearful and too gun shy. You just want to be ready, but you have to face reality at times. And right now, as you guys can see with your own two eyes, you don't need me to tell you that. I don't really watch anything in the credit markets. You're going to hear it. You're going to hear it. You're going to feel it, because the credit markets are going to have an effect on the equity markets. By the time we, see anything or find that out, more than likely there's going to be a reaction in the equity markets. Right. Like you look at, and there's quite a few people that say it's not as important, but Hartnett from Bank of America, who we all like, right, says to keep an eye on, what is it again? LQD, that's it. LQD, which has been awful, right? Awful. And this would symbolize liquidity. Okay, so sort of like the chart I just showed you about financial conditions, that's kind of what this can measure. And you look, right? Look at this. Right? Remember they came in and they rigged the market to buy these things? Now you got a little spillover here, okay? But I think what Hartnett was mentioning, he thinks it's even more important, is if this rolls over, because he thinks that can take down the whole market. See, like the other one I just showed you is not taking down the indices. It's just underneath the hood, you're seeing the pain, right? Here, his opinion, he thinks HYG is a better measure as far as having an impact on the indices. All right, but the thing we got to remember, okay, no matter what, if something gets ugly, you think the Fed's not going to do anything? That's what I mean. Don't get bared up. It doesn't pay to get bared up. Right? The Fed, as soon as Powell sees that he's wrong and the market is right, trying to force him into a corner, that's when they take out the tools and they do something like this. And then you probably have an incredible entry for swing positions. No, maybe not this. Maybe it's something else that gets the job done. I don't know. I don't know what the Fed has up its sleeve. So don't get too bared up. And the other thing too is, even aside from the growth names, because that's what we all want, but it may take time. It may take time. These growth names were so hot. SPAC just blew up. They're still coming out with a gazillion SPACs a day. That's got to dry up. SPACs got no one. If you got to get to a point where hardly anybody even has an interest in SPACs anymore, for good reason. No one has an interest in Kathy names because she's buying them for 5 years out and they're dead wood. You got to get to that point, and that's more of, I think, time than pain. Because pain, people see bargains. People see Kathy dead wood. Well played. There's nothing wrong with Kathy, but, she stepped in shit as far as timing is concerned, because you couldn't draw it up any better for her. You couldn't draw this up any better for Kathy here. Okay? You couldn't draw it up. Couldn't draw it up. Like we spoke about, when Kathy was buying Tesla and Tesla couldn't get out of its own way, and she was putting absurd target prices back then. Back then, she was talking crazy targets, and people were making fun of her. They were abusing her over here. Abusing her. Kathy Wood. What's that piker know about Tesla? $1,000. Right? It's the same Kathy Wood. It's the same Kathy Wood. Yeah, no, now they're not making fun of her. Now they were tailing her trades. Literally tailing her trades. And you're not going to make money in the market doing that. Because if you can do it, that means everybody can do it. It's not going to happen. I mean, a lot of these things really have gotten beaten up already. Some may have lower to go, but I just think I think there's more time of doing nothing. Not even Tesla, but the rest of them. You know what I mean? More boredom, more chop, more a dead period. And then they'll get hot again. And likely, they'll be off something the Fed did, or, the timing will sync up with that. So in the meantime, what can we do now? All right, this is the first bullish case we got, right? We have the reopening names, okay? An entry looking at those particular names and groups off some bullish sentiment. That's the first thing that's visible to me right now that we could keep an eye on. Yeah, sit tight. And again, Dad, you hit the nail on the head. What we can do in the meantime, it's not going anywhere. Okay. What we can do in the meantime, we could wait for short-term bullish sentiment signals and play off of that. You know what I mean? We could play off of that. And there'll be trades there. We got to be careful what we buy. There's usually, when you get those sentiment signals, you can buy a lot of things and make money when the bounce comes, but now more than we had to, you got to watch, right? A name like, I don't know, maybe a name like a U or one of those names, maybe they don't bounce with the market or sentiment. Yeah, and taking profits quicker when, like, a healthy sentiment, when we get a sentiment signal, all right, the ones that work, and there's a hell of a lot more that work than don't, okay? When you get it, it's not like you have to take scalp and take the profits off the table. It's going to be a decent move. It's just going to happen in a shorter period of time. You know what I mean? And you just got to be more realistic. You got to be more realistic, right? Like, that's what I mean. Like QS, okay, is not going to be right now, and that's all we can measure it up against. Right now, QS is not, the odds are that it's not going to be the way QS used to move. You know what I mean? It's just not going to happen. Nothing's moving like that. Nothing. So you would need some huge piece of news to get QS to really bust out here. Okay? That's what you're banking on. And, the odds of that are a lot less. right? Without news, QS is likely going to pop, pull back, and hang around and do a whole bunch of nada until this climate changes. You know, that's kind of the problem I have, like this name, right? You know, how could you not like the action in this name? You know, how could you not like it? But when I take a step back and look, I say to myself, look at this, okay? And now, you know, I'm buying here, and is this thing going to bust out by itself? Is this thing just going to rip higher all by its lonesome? You know, the only way you could probably do that is with what? News. I got to get lucky and catch news. You know, what's the likelihood that Nuon over the short term, from what we can see right now, is just going to break out from here and end up being a really nice swing trade? You know, it's not a high probability. Not a high probability. Okay. And if rates go up and growth and tech are being sold, there's a good chance that this is going to see some selling too. It may not fall apart, but it's not going to buck the trend and go higher. And the likelihood it may come down, test these lows, right? So you're in a swing trade for low odds of a breakout, something you're probably going to sit in for a while unless the climate changes. You know, could you do it? Yeah, you can make the argument that you could do it. You're willing to sit through it. You really like the name. You know, you're looking to buy more if it comes down. You know, you're playing the Octobers and you have a ton of time. Like, you could make arguments to buy it, but I'm just making the point. Like, for me, it's so difficult to pull the trigger on a swing trade for those reasons. You know, for those reasons. You know, like this thing, you know, had a huge move here. Huge. Like, this is just, right now, this is normal digestion. This is not even what's happened to some of the growth names out there. They've been obliterated. This thing's not obliterated. This thing's holding its own. You know, it's kind of like, I remember PayPal. I bought PayPal back a couple years ago into a correction, and I was early, you know, and the action was incredible. But boy, you know, I wasn't ready. Even though I had time, I wasn't ready for the agita of just being teased by it. Every time it went up, came right back down, you know? And I was better off just being a little more patient. Even if I missed that PayPal that ended up being a nice winner, there was so many others when the time was right. You know, there were so many others. But PayPal, like, I bought it and I was early, you know, and it was agita. It was agita. I'm trying to see on the chart where it was. It was a while. Oh, here it is. Agita, stress. So I don't remember exactly the entry, but I had a nice entry. It was off weakness. It got bombed. And, you know, it was a swing trade that I built a decent sized position in. I did not want to sell these pops. That's not why I went out with so much time, you know, and this is what I had to deal with. Up, down. Now I'm down on it. Up, down. You know what I mean? And it was over the course of, you know, 2-3 months. And then finally ripped, and I sold it right here. I sold it right here anyway. You know, that's usually how it goes. And this thing, I waited all that time to sell it right here, and I missed 3/4 of the move. But you know what I mean? This is a good, the best names. We might be in store for something like this. Totally normal. Totally normal. You know, if not longer than that. Because they've had crazy moves, guys. They've had crazy moves. So that's why the other stuff like energy, the financials, if we get, a little more selling there, and they set up, there might be a nice bounce trade there because people are interested. So I don't know if you want to play ETFs or names there, but there could be more. You get, comes down a little bit more, and then you get an entry here off a bullish sentiment signal. It's not your initial entry here, but you got another decent entry for at least even a trade. Swing, I like this names that meet my criteria for a swing. Some names I like a lot. Like here's a name I mentioned to you guys, PG, that I think you probably, if the market goes down, might be a good thing for PG. Might be a good thing because this is a flight to safety. That's another thing we've been seeing more of, right? In the flow, these defensive names. When you start to see them pop up, you don't want to see that. You want that to end quick. But this thing, they came in, they sold puts, they bombed some Jan calls. So this is something you may not even need the market. It's hard to get gassed up on it though, no? It's hard. But if you needed something to buy, the flow there was definitely swing trade worthy. The new one, ATVI has been catching nice action the past 2 days. Very similar to Nuon, right? ATVI. Very similar to Nuon. It's like, it looks good. Doesn't look bad. Right. One that looks bad, but, can definitely, that's why I haven't pulled the trigger on the calls. I can't do it. This Sumo. This thing could sit here for 2 months. Yeah, this thing doesn't have to go anywhere. Who the hell's going to buy Sumo with everything that's going on in these growth stocks? You know what I mean? They're not buying legitimate names out there. People that people know of and know the companies, and right? So this Sumo could sit here, best case scenario, just sit here. I mean, there's a lot of time in those calls anyway. What was it, August, the risk reversal? But the reason I haven't started here yet with Sumo, even started, is because, it's really been beaten down to shit. If rates are going to go higher, right? If rates are going to continue higher because of reopening, this can go lower. This could keep going lower. This could definitely keep going lower. No doubt about it. There's no doubt about it. Again, rewind to 2018 when the Fed was tight and was stubborn. I don't know if you guys remember the price action. I remember it because I was stuck in IGT at the time. And I was like, wow, this thing got crushed. How much lower can it go? I thought I had a great entry. It went down every single effing day. Every day. Every day. Look at this. Look at this. And this wasn't the only one. If this was the only one, I'd be pissed at IGT. There was at least 3/4 of the market at the time that looked like this. Every cyclical name under the sun that's doing well right now looked like this, if not worse. Down every single day. There'd be one little squeeze for a couple days, boom, sellers. Crushed it. Crushed it. And, and here's my point, right? Prior to that, you think of IGT as a piece of crap. IGT was a good stock. SGMS was another one, right? They're in the same sector. Look at SGMS, okay? This is what SGMS did before getting caught. Look at this move. right? This thing was a beast. But then the playbook turned against it. Look at this. Okay? Nightmare. Nightmare. So, you know, you don't know how long it could go on for. I'm not saying it goes on. Think of this. The Fed hopefully learned their lesson from that point, right? You know, they should have learned their lesson. It's different now. It's a little different now because it's not that they're raising rates, right? But the point is the market was trying to force the Fed to acknowledge something, and they didn't. And they played, not only did they not do it, they did the opposite of it. And the market took down everything it needed to take down. You know, took down everything it needed to take down. And you guys remember the correction. You know, the end of that correction was pretty ugly. So we're not seeing any of this in the indices yet at all. You know, we may not. You know, we may just see little pullbacks here and there because it's different. But underneath the hood, that's what matters to us if you're playing individual names. You know, so this is what the indices look like, right? So there were some decent trades in the indices, but the names that were called for being sold in the playbook, there were no buyers in them. No buyers. You know, no buyers. So that's my point. Like the indices, if we do end up in that time, you know, you're better off looking for trades in the indices than names because names were impossible. You know, impossible. Seasonality, you got some poor seasonality here for the next week or two, and then seasonality becomes more favorable into April. So seasonality turns sooner than later. You know, but we got more than enough to watch in front of us. You know, more than enough in front of us. We got more than enough. Anybody have any questions? You know, as far as names are concerned, yeah, we want to talk about names, we could talk about names, but they pretty much all fit under one hat or another. Root caught some action, but they're rolling strikes, so I wouldn't get too excited about it. Check open interest tomorrow. Maybe today's buying a little bit cleaner. So it's somebody probably who took a shot here and was early and now just coming down in strikes because they were too far out of the money. Yeah, Roku, what was it? Weekly action, you know, and I don't like playing names. Well, it was down today. I even realized that. I thought Roku was up. But Roku was weekly action. Wasn't it up today, this morning, or yesterday was up maybe? I mean, you know, it looks okay, right? It looks like Nuon. But I don't, what are you looking for new highs? We're going to have earnings coming up too. That should be interesting. You know, we're going to have earnings. But yeah, this is in the start of a breather here now. You know, this is in breather mode officially. The question is there one more leg south, or does it hang out here for a while? You know, until the climate changes. Like, look, this is a name we keep going back to look at. All right, Teladoc. Soon as it goes into breather mode, like this is what you're in store for. Oh, it happened to get out here. I don't know how the hell it did that. They yanked it right back in. But you know, this is what the breathers look like. You want to trade through that? You know, make sure you got those nice entries and you sell them into rips. Problem is you don't know how much of a rip you're going to get. But nice entries pay. Yeah, airlines, all these reopening names, now that we got this dip, become actually we could become a little more interested in now. So if you get a dip here, it might be worth a shot on some of these things. Like Trip. Remember Trip? Look at that rip, by the way. Yeah, you get a dip here, you might have an opportunity for a decent trade in Trip. But yeah, all these reopening plays, energy, gaming, leisure. I think Ryan just mentioned MLCO, the casinos. We might have an opportunity to get a trade out of these things. We might have an opportunity. C's, they all ran hard or no? Wow. I didn't realize how much that ran. Yeah. So I think we got a better shot at that first, getting an entry here somewhere. Because if rates are going to continue higher, right, we are going to reopen the economy. It's pretty much COVID in the rest of the world that's an issue. It's not here. The economy is going to reopen. So I still think there's another trade for us at some point here. May not. I don't think it's going to be that. You know what I mean? But a more normal trade. Energy names. You should start. You should start building a list of energy names. They actually held up well today, compared to some of the names. Crude got smacked again. Yeah, this is just a normal pullback there. FCX. The tough part is where, right? Where's the spot? Where's the spot? That's where I'm saying the sector sentiment might be a good thing to look at. If you get bullish signals, energy, materials are so far away. But financials, if we get bullish signals from sector sentiment, maybe a good spot to fire. But there are a lot of energy names. This one caught some action today. This was one of the first energy names to catch decent action when they started to buy them. CPE. It was like $11 over here somewhere. Got up to 42. And there was a little buying. Look, see what I mean? Closed off its lows. There was some buying there today. Gold, I have no idea. I have no idea. Rates going higher, that's not good for gold. So I don't know how you could get bullish gold, can you? If rates go up, gold doesn't like that. So I kind of think gold might be in the growth camp, DW, but I'm no gold aficionado, so don't, you know what I mean? I wouldn't put too much weight into my word there. I don't really follow gold close enough. But as far as I know, I think gold doesn't act well when rates are moving higher. I mean, rates could go up. Rates could definitely go up. I don't know if there's a magic number. I really don't. I don't think anybody knows if there's a magic number. It's the pace of it. But think about this. You went from an economy that basically, like a switch, was shut off. Right? I mean, that's as bad as you're going to get. That's the bottom. So now everything's being turned back on. Rates should go higher. Everything's opening up again. So the only way that rates don't go higher here is if the Fed comes in and manipulates them, right? No one. normal economics, rates are supposed to go up here. That's normal, especially with some of the growth that we're expecting, right? People are expecting mayhem when this economy officially opens up, everyone vaccinated. So rates are going to go up. There's no logical argument you can make for rates not going up initially as the economy reopens. Eventually, maybe they reach a point where, they overshoot and come in, stabilize. And again, I'm not making the argument that rates shouldn't go up. I think it's normal. I think it's telling you the promise of the health of the economy, that we're reopening. You understand? It's not, playbook wise, it's not good for growth and spec stuff. All right, so think of it like, just rewind to where we were into the lows of COVID. Okay, it was the complete opposite. That was, the Fed chopped, rates were non-existent, liquidity influxes all over the yard, right? In that environment, you want to buy high growth and spec. Like, that's what you want to buy when that happens. Okay, so now it's the unwind of that. You understand? So now that's being unwound. That's why it was such a crazy atmosphere once the market got going to the upside. Once it caught fire, the liquidity was nuts. There was so much money to buy. There wasn't enough stuff out there to buy, right? They wanted to buy Bitcoin. They wanted to buy SPACs. They wanted to buy this. They wanted to buy that. Now, there's a lot of shit out there. Now the economy's opening. There's a lot of supply out there. So it's just the I wouldn't say the opposite of where we were. It's being unwound. It's being unwound. So that's what I'm saying. Like, growth, it doesn't have to, these growth names don't have to get killed, but it's just not going to be an environment like that, like we saw in those names. They're going to be tougher trades, without a doubt, at best. So again, Bank of America Hartnett, who's pretty much been on the money with the call, has, his feeling is that when the market tries to make a point, the market tries to make a point. There's no turning back. And it's going to box the Fed in a corner. It's just a matter of when. And when the Fed pivots, that's when there'll be an opportunity, an entry for a real nice trade in the stuff that's out of favor right now. Yeah, so again, we're talking trades, right? The majority of people in here, Aurelio, we can't sit in a stock for a week without complaining. But if you're an investor, right? You're looking for high growth names and you're putting them away and you're looking for entries. You want to take advantage of weakness in these things. So you want to buy a little, you like a name now, you want to buy a little now. It comes in more, you want to add and buy a little there. You understand? So you see kind of what Kathy's doing. She's got a 5-year outlook. So she's going to buy these things, her go-to names, into weakness on pullbacks. So that's what you do when you invest. Trading is a whole different animal, especially options. You have a time limit. Not only do you need the stock to go higher, you're predicting the time. So all this other stuff is important. You want a suitable trading environment, right? You want, again, we talk about odds and probability. You want higher odds of success for trades. right? That's where you want to participate and be most aggressive. And right now for that, it's not the case. We just had from March all the way up till a couple weeks ago, a month ago, we had incredible time. But yeah, find names you like, just let them come in. You know what I mean? Let them come in. Buy a little and let them come in if they're growth names. You see, like here, right? Like Caterpillar's a solid name, no? Like Caterpillar's legit, right? If you're an investor, all this pain, right? If you dollar cost averaged in, if Caterpillar was a name you really like and you were buying off weakness, you're sitting pretty here, right? As an investor. As a trader, you pulled your hair out of your head. You pulled your hair out of your head. And some of you young guns out there are like Caterpillar. What is he comparing Caterpillar? You don't understand. Caterpillar was the beast. Caterpillar was Teladoc. Okay, Caterpillar was the stock to own before some of you even started playing this game. But things changed. It peaked out, and then it went into some long consolidation and choppy consolidation. But you had a lot of different things here, right? You had the trade war, you had the Fed tightening or trying to tighten, so you had a lot of stuff here go against you. But if you were an investor, you wanted to take advantage of these yanks, right? You take advantage of them. If you're an investor, a trader, you would have died of old age by that time. GameStop earnings are out. Oh, you guys made me miss GameStop earnings. I've been waiting all quarter. Wrecked. Oh, I see it here, the blue line. Yeah, it's down. It's down, but you guys don't have diamond ring hands. You guys are pikers. If you have diamond hands, you don't hold the line, will you? What Palliapati say or Cuban? Hold the line. Stop being a piker. Hold the line. I got $1 billion in the bank. I flipped my calls for 100% in 2 days, but you hold the line. I couldn't stop laughing. And nobody was talking about that. Like the guy's worth billions. He flipped his calls. He rolled the dice on calls and he flipped them in 2 days. The money means nothing to him. Nothing. And after he sells them, he's telling every little retail trader out there to hold the line. Can you imagine? Hold the bag, he was telling them. But he couldn't even hold his calls. That mean nothing to him. Unbelievable. Right? And what did he make on that trade? What did he make? A couple $100,000 or something? He said he was going to donate it? $600,000? That's a Slurpee for us. You know what I mean? Yeah. Cover them up. But why? You're telling people to hold the line. Why not hold your calls? What are you so afraid of? The anti-VIX chart basically is an intraday measure of VIX buying and selling. So when everything I post green and red, green means bullish to us and red is bearish to us. All right, so when it's near the green line, that means that they're buying VIX excessively. And usually that signals bounce in the market. Understand? But the anti-VIX, I named it the anti-VIX indicator. It measures VIX buy, sell, and we look at it in a contrarian way. You know what I mean? So just like any other indicator we look at, the green line means bullish the market. The red line, no. Never, all the indicators I use, they never, I see what you're saying. You thought it was for VIX itself. I got you. No, that's why it's the anti-VIX. Right. The market. Think of it as the market. I don't know, Sean. It'll be interesting. I'll find out either later tonight or tomorrow, and we'll see what the hell they're doing. As far as I know, they're not anticipating anything climactic in the indices, in the S&P 500. You know, but you never know. Things change. So I'll give you guys an update later tonight, most likely in the morning if I get it late. You know, if I get it late. No, I got to update the squeezometer, and I'm going to post all the sentiment updates as they come in through the night. We'll see where we're at. We should be in okay shape at the least going into tomorrow. You know, we should be in okay shape. So at least maybe, that's what I like about when we get tactical sentiment favorable. Even the day trades are solid, you know? Even if we can't get our hands on a swing trade, the day trades are solid. But if we get, we should get a decent reading tonight. And then tomorrow, if there's any weakness, we want to look for something to buy, you know? That's what we're looking for. Put question. Nah, I don't have anything to protect, Eugene, but I would. If I was long, you know, uncomfortably long, I would definitely put on protection. Me personally, like my protection's going into a substantial cash position. But yeah, I've been saying that from the beginning of the year. So I was early and, you know, still early, but I would definitely protect if I'm aggressively long here. You know, and if you were aggressively long growth names, it's almost too late for that, right? So kind of I wasn't that late at the beginning of the year for the indices, yeah. December 2000. Is there a correlation with that? I haven't even seen it, Tim. It looks just like it. Interesting. I'm going to take a peek. I haven't even seen that. I know there's some correlation too with 2010 S&P 500. A little off, right? Yeah, I was just talking about that, Dan. I think I have a chart. I got to dig it up. I think we're a little off whack where we were just perfect, if you remember. But we're pretty close. Why buy? I don't like candlestick. I don't use candlestick. You know what I mean? I don't read charts with candlesticks. I like dojis and shit like that. So I can't read them. Like sometimes I'll look at a candlestick. I don't know what the hell the stock did that day. You know, it's engulfing my vision. So I've always been a bar chart guy. I'm an old school guy. So candlesticks, I don't really fool with. I don't use them. That's why. Niner script. Yeah. I mean, there are a ton of Niner scripts on TradingView. I would just recommend you go on there one weekend and just fool around, whichever one you like. There's a few nice ones. I switch them up from time to time. That kicked off low volatility. Yeah, post a chart. Tim, post a chart. Exactly. In the room. Or send it to me on Twitter. I'll retweet it. All right, guys. Anybody have any other questions? Yeah, Facebook did break out, but you know, it's slim pickings. Like initially when Facebook started to move, I was kind of hopeful that maybe it would spill over into underbelly tech, but it didn't. So for one name, it wasn't worth getting excited about unless you had a trade in Facebook. And some of you did. So kudos to you. Netflix has done okay, but yeah, they're choppy as all hell. This is not no easy stuff here. Look, Amazon, they're not really going anywhere too far. It's tough. Yes, underbelly. That's what we're looking for. Exactly. All right, guys. Always a pleasure. Appreciate you guys stopping by. Enjoy the night. Members, keep an eye out for some sentiment stuff tonight.